I used a HELOC to purchase a cash flowing rental property, and I'm going to be showing you exactly how you can do the same, the breakdown on the numbers on the property I purchased, the mistakes that I made and you need to avoid, and at the very end I'll be going over if using a HELOC is a good idea when purchasing a rental property. All that and more, so make sure to stick around to the end. What's up everybody? If you are new, my name is Evan Phoenix and this channel is all about real estate education and my journey to financial independence through real estate investing. So if that's something that you're interested in or you like this video, please consider giving it a thumbs up. It would help my channel out a ton. So a little over a year ago, I pulled out a home equity line of credit on our 4-unit apartment building. This building started out as a house hack for us, but after 1 year of living in one of the units and renting out the other 3, we decided to move out, and ever since it has strictly been a rental property. If you are unaware, a HELOC is a loan product that stands for a home equity line of credit. This is a real estate strategy to where you can leverage the equity inside of your property and put it to use without having to sell it. Think of it very similar to a credit card in the way that you are given a limit and you only pay on it if you draw from it. And to apply for a HELOC, you would go to a credit union or a bank and get anywhere between an 80 to 90% loan to value on a primary house, or anywhere between a 70 and 80% loan to value on an investment property. But the most important thing that you have to watch out for with a home equity line of credit is the variable interest rates, but more on that in a little bit. So after pulling the HELOC from our 4-unit apartment building, I knew I wanted to put that money to work in order to get a good return on investment. And the only way that made sense to me and aligned with my financial goals is to invest it back into real estate. So with our HELOC, we ended up purchasing this duplex last year in March. In order to purchase this, we used a commercial loan product. Just a quick tip, if you are going to use a HELOC to purchase a rental property, you may want to use a commercial loan product. The reason I say that is because when using a commercial loan product, they look more on the actual investment property, how much it generates versus how much expenses it has, rather than looking at your debt to income ratio, like if you were going to apply for an FHA or conventional loan. So this was a very creative deal. We ended up purchasing this duplex for $270,000 with a $60,000 seller contribution. But the bank agreed to use the seller contribution towards the down payment, meaning that instead of putting the 25% down of $67,500, I was able to take the seller financing of $60,000, apply it to that down payment, and all I had to put down was $7,500 plus closing costs. So at the end of the day, I only had to put down about $19,000. The best part about it was that the $19,000 I brought to the settlement table was from our home equity line of credit from our 4-unit apartment building. So essentially I put $0 down on this property, our HELOC paid for it, plus a little bit of seller financing. I know I kind of breezed through that, but I hope that made sense. Now you might be saying, does this property cash flow and what are the numbers as far as the income and expenses? So let's go ahead and jump into that right now. Okay, so getting into the numbers right now, so you can see that the rents coming in from the units, unit 201A and 201B, is $1,400 and $1,350, but we also do a utility charge since I pay for the water and the sewer and trash. So we do a $50 per unit utility fee, and that brings the grand total of the units $1,450 and $1,400, which is $2,850 a month in income that we receive from this property. Now going over to the expenses. Now we have the mortgage, which includes the principal, interest, taxes, and insurance of $1,567.94. We have the PM, which is property manager. We have a management company that manages this for us, and that is $208, which is 8% of the monthly gross income every single month. Moving on, we have the water and sewer that I said that we use, which is roughly about $90. So that utility fee that we charge for both units pays for that. So what we did is we had the $60,000 seller finance, interest only payments at $200. And then we're going to do a balloon at 5 years, and we're going to repay back the seller. Now moving on to our last expense, which is our HELOC. Now you may be thinking, holy crap, $400 is a lot of money for that HELOC and only using $19,000 of it. But I am overcharging for this right now. So the real payment is really only, $130 a month. But if I pay more a month, it would be applied straight to the principal instead of just the interest. So what I do is I pay $400, sometimes $500 every single month in order to pay off our interest only payment due every single month and apply the remaining amount to the principal to pay it down faster. So really I only have to pay about $130, but I put $400 in order to pay it down faster. With our income of $2,850, you subtract the $2,465.94. That brings us to a cash flow of $384.06. But you have to keep in mind that when owning rental properties, you're going to have damages to the property. You're going to have to repair and maintenance to the property constantly. Well, yes, cash flow is something that I really like and I look for in a property, but I'm also having the tenants pay down my loan for me on this property, and I'm paying $0 for it, but my tenants are paying it down. Not only that, but I can depreciate and have tax benefits in order to lower my taxable income. Not only that, but this property is in a great area that's appreciating, so I'm earning equity just by holding on to it. Now, the last thing I want to do is make it seem as if I hit a home run and there was no difficulties whatsoever during this process, because there were. I made 3 main mistakes when using a home equity line of credit that I wish I'd had more due diligence with. And I want to share with you because not only do I not want you to make these mistakes, but I also want to drive home the point that due diligence is so important. Although I'm happy with my investment, I learned a lot. The first mistake I made was using a HELOC for longer term debt. When using a HELOC, you really want to use it for shorter term debt. And the reason being is because the variable interest rate it has, and it moves with the prime rate of the market. As of mid-year 2023, the interest rates are extremely high. So I started off with a 4.5% interest rate and it rose to a 8.5 interest rate. That's a huge difference no matter the amount that you take out. And honestly, it could crush your cash flow and crush your deal if you didn't account for it. The second mistake, which I mentioned, was a variable interest rate. Now, I knew going into it that there was a variable interest rate and then it moves with the prime rate. I did not know that it could go up to 8.5% from a 4.5%. So although it's only interest-only payments on the HELOC as of right now, and it barely changes the payment, it's still a difference. And luckily, I over-accounted for the amount of the HELOC, so I can pay that off. But if for some reason I did not account for that adjustment, I could be losing money on this deal and eventually be stuck in a hard situation to where I may be forced to sell. So always keep in mind that the variable interest rate can rise. And the last mistake I made is always have multiple ways in order to pay back this home equity line of credit. If you are relying solely on the cash flow, then that is not good whatsoever, because if for some reason something happens to the building, you're not getting your rent, and then your W-2 or your day job cannot pay for that home equity line of credit, well, then you can eventually lose that property and the property that you pulled the HELOC out on. Luckily, although I did plan on only the cash flow paying for it, I can come out of pocket from other properties I have or my W-2 income, so I am fine on that end, but at first I did only plan on the cash flow paying for it. Now, I'm going to say that overall, using a home equity line of credit in order to purchase a cash flowing rental property is a good idea, and only a good idea if the property cash flows. Being accurate with crunching your numbers is really the only way in order to protect yourself from buying a liability instead of an asset. You really want to educate yourself on the loan product and have a plan in order to pay it off. If we are strictly going to be talking about using a HELOC to purchase a rental property in 2023, although it can be done, I think is extremely risky, especially right now, considering the variable interest rates on your HELOC, the higher interest rates in the market, the relatively high prices still in the market, and over leveraging. Not to mention, if you cannot pay that HELOC back off, then not only can you lose your rental property, you can also lose the property you drew that HELOC from. I hope this video was entertaining and educational. If you liked it, please give it a thumbs up. It would help my channel out a ton. Thank you, and I'll see you guys in the next one. Happy investing.